There's a transaction that happened 3 weeks ago that almost nobody noticed. A copper mining operation in Zambia sold 15,000 tons of refined ore to a Vietnamese manufacturing plant. The payment cleared in 11 minutes. On the surface, this looks like standard international trade. Commodities move, money moves, contracts settle, except for one detail that should make you pause. The settlement never touched the dollar, not as a bridge currency, not as a reference unit, not even momentarily. The payment moved through something called the unit payment system, a financial infrastructure backed by physical commodities and launched quietly in January 2026. And if this is the first time you're hearing about it, you're already behind the curve. Because while headlines focused on stock market corrections, interest rate speculation, and election cycles, 3.2 billion people quietly gained access to the first credible alternative to dollar-based settlement since the 1940s. This isn't a pilot program or a policy proposal waiting for approval. It's operational infrastructure processing real trade right now. And the implications are not subtle. To understand why this matters, you have to rewind to a moment most people think they remember, but don't fully grasp. March 2022, Russia invades Ukraine. Within 72 hours, Western governments freeze more than $300 billion of Russian central bank reserves. Not trade sanctions, not asset seizures targeting individuals. They immobilized the reserves of a sovereign nation's central bank. Money Russia accumulated over decades by selling natural gas to Germany, oil to Italy, wheat to Egypt, locked, untouchable. And in finance ministries around the world, something shifted. Not publicly, quietly. Every treasury official in Beijing, every central bank governor in New Delhi, every finance minister in Riyadh watched that freeze and understood something fundamental. The global financial system isn't just a neutral payment network, it's a compliance mechanism. And if your national wealth sits inside assets controlled by foreign governments, then your reserves aren't really reserves, they're conditional assets. They work until they don't, and the conditions are political. This wasn't hypothetical anymore. For decades, economists debated whether reserve weaponization was possible, whether it would ever happen. In March 2022, it happened. Demonstrated, proven. China holds roughly $3.2 trillion in foreign reserves. India around $650 billion. Saudi Arabia about $470 billion. Japan more than $1.2 trillion. Every one of those governments asked the same quiet question behind closed doors. Could this happen to us? And the uncomfortable answer, the one that keeps appearing in classified risk assessments, was yes. Not because they're planning invasions, but because the criteria for freezing reserves proved to be flexible, subjective, and expandable. A military conflict, a territorial dispute, a trade disagreement, human rights interpretations, domestic political choices. The ambiguity itself became the threat. When the rules aren't fixed, compliance becomes permanent vulnerability. The response wasn't announced with speeches. It didn't arrive through press releases. It moved through capital flows. China and Russia accelerated de-dollarization programs that had existed quietly for years. By late 2023, 90% of trade between them settled in yuan and rubles. Not half, not most, 90%. Roughly $240 billion in annual trade volume that once required dollar intermediation suddenly didn't. Transactions cleared. Liquidity existed. The system worked. India began purchasing Russian crude in rupees and dirhams. Saudi Arabia started accepting yuan for oil sales to China, quietly breaking a 50-year petrodollar exclusivity that had defined global energy markets since the 1970s. Brazil and Argentina began formal discussions on a shared settlement currency for regional trade. These weren't symbolic gestures. These were operational shifts happening while Western media debated whether sanctions were working. And what almost everyone missed was this. The freeze didn't just scare countries that might face sanctions. It scared everyone because the precedent was established. If a G20 economy's reserves can be frozen, then no reserves are untouchable. And once that realization sinks in, the logic of building alternatives becomes unavoidable. This wasn't about helping Russia. It was about survival, about optionality, about ensuring that no single political bloc could unilaterally disable a nation's financial system. When UNIT launched in January 2026, it wasn't creating demand. The demand already existed. The freeze didn't create the idea of an alternative. It created urgency, and urgency accelerates infrastructure in ways ideology never can. So, what exactly is unit? Not philosophically, mechanically. How does it function? 40% of unit's value is backed by physical gold, not paper claims, not ETFs, not promises, physical metal allocated in audited vaults, specific bars, specific serial numbers. When a central bank holds units, 40% of that value corresponds to actual gold stored in verifiable locations. And BRICS nations didn't start accumulating gold recently. China added more than 340 tons in 2023 alone. Russia has been buying consistently since 2014. India holds over 800 tons. This was a decade-long preparation hiding in plain sight. The other 60% of units value comes from a weighted basket of member currencies: the yuan, the rupee, the ruble, the rial, the rand, along with currencies from expanded members like Saudi Arabia, the UAE, Egypt, Iran, and Ethiopia. The weighting reflects GDP contribution and trade volume. China's yuan accounts for roughly 40% of the basket. India's rupee around 18%, the remainder distributed among other members. Holding units means holding exposure to the productive output of economies representing roughly $28 trillion in combined GDP. This structure solves a problem that destroyed every previous commodity-backed system. Gold alone doesn't scale. Global trade grows faster than gold supply. That's why Bretton Woods collapsed. The United States couldn't maintain gold convertibility as dollar supply expanded. Unit avoids that trap. Gold provides a floor, a credibility anchor, something that cannot be printed away. The currency basket provides elasticity. As BRICS economies grow, unit supply can expand without requiring proportional gold accumulation. Stability from gold, flexibility from fiat. It's not perfect, but it's structurally superior to pure fiat systems with no anchor at all. Compare that to the dollar. Since 1971, it's been backed by nothing but confidence and demand. When the United States runs trillion-dollar deficits, when the Federal Reserve expands its balance sheet by trillions, the dollar debases. There's no built-in constraint. Unit has one. 40% of its value cannot be inflated away, and markets are already responding. If even 15% of global trade migrates to unit settlement, gold demand rises structurally. Central banks need more gold to back issuance. Commercial banks need gold inventory to facilitate transactions. Non-BRICS countries accumulate gold as insurance. Commodity desks have modeled this scenario. If unit reaches 12 to 18% of global reserves by late 2027, gold prices approaching $4,800 an ounce are mathematically plausible. Not speculative hype, simple supply and demand. Now consider scale. BRICS began as 5 countries. Today, it includes major energy exporters, logistics hubs, manufacturing centers, and population giants. Over 40 countries have formally expressed interest in joining or integrating with its payment systems. But country count isn't the story. Population is 3.2 billion people. 41% of humanity now lives in countries with access to a functional dollar alternative. That's unprecedented. When a business in India trades with one in Brazil, they no longer need to touch the dollar. No exposure to Federal Reserve policy, no risk of payment rails being shut off. Combined GDP sits around $28 trillion and is growing faster than Western economies. China above 5%, India nearing 7%. The economic center of gravity is shifting in real data, not forecasts. Network effects make this unavoidable. 5 countries experimenting is a curiosity. 10 makes it viable. 40 makes it inevitable. Every new participant increases liquidity, stability, and usefulness for all others. This is exactly how the dollar rose after World War II. Except now, the network effect works in reverse. Saudi Arabia joining matters more than ideology ever could. The country that anchored the petrodollar now accepts alternative settlement. The monopoly is broken. The UAE follows. Iran integrates because exclusion leaves no alternative. Egypt matters because the Suez Canal handles roughly 20% of global container traffic. If Egypt accepts units for transit fees, Every shipping company needs access, not politically, operationally. This isn't a coalition of weak states challenging the system out of resentment. It's a collection of economies controlling energy flows, trade choke points, manufacturing capacity, and population scale. And they aren't asking permission, they're building quietly. Month by month, more countries run the same calculation. Dollar dependence equals vulnerability. Optionality equals survival. People expect collapse, a dramatic dollar crisis. That's not how reserve transitions work. When the British pound lost dominance, it took 70 years. Britain remained powerful long after economic primacy passed to the United States. The decline was slow, incremental, invisible until hindsight made it obvious. Trade settlement shifted first. Reserves followed later. Confidence eroded last. That's the pattern. And it's repeating, except faster. Technology compresses timelines. Software replaces decades of infrastructure. Coordination accelerates adoption. This isn't passive displacement. It's intentional construction. That doesn't mean the dollar disappears. It means its monopoly ends. And monopoly's ending changes everything. It changes how central banks allocate reserves, how corporations hedge exposure, how sanctions function, how inflation transmits globally. The erosion has started. By the time it becomes obvious, it will already be far along. Skeptics point to BRICS fragmentation. China and India distrust each other. Russia and Saudi Arabia compete. Political systems clash, that's all true. But they're not unified by shared values, they're unified by shared vulnerability. The fear of financial weaponization is stronger than ideology. It doesn't require friendship, it requires alignment of incentives. Once infrastructure exists, exit becomes costly. Disputes continue, but participation persists. History shows adversaries cooperate when alternatives are worse. So, what does this mean for individuals, institutions, and states watching from the sidelines? It means the world is entering a dual system phase. Dollar dominance doesn't vanish, it competes. And competition introduces risk where certainty once existed. Holding everything in one currency becomes a bet, not an assumption. Gold regains relevance not as speculation, but as neutral collateral. Real assets matter more. Commodities, infrastructure, energy, food. Tangible things that retain demand regardless of settlement system. By the time the shift is openly discussed on mainstream networks, positioning will already be done. Central banks will have diversified. Corporations will have adapted. The early phase is always quiet. That's where we are now. January 2026 wasn't an announcement. It was a switch being flipped. The largest restructuring of global finance since Bretton Woods didn't arrive with fanfare. It arrived with an unnoticed copper trade clearing in 11 minutes. And that's how history actually changes, quietly, then all at once. All.